Joining me now is Udo Frank. He's CEO of RCM Capital Management, which manages $141 billion in assets. He's joining us from our San Francisco bureau today. Thank you so much for joining us. We appreciate it. So, Udo, first of all, I just want to ask about the sell-off that we've now been seeing for quite some time. I mean, do you think that these concerns in the market, which seem to be largely surrounding Europe, do you think they're justified?
Well, Julie, we have been talking about and expecting a correction in the marketplace for quite a while at RCM, and I guess you could say that when it comes, it's always a little bit of a surprise. But we believe this is the correction we have been expecting, and one needs to see it in the context of that almost straight-lined rise of the market since March 9th of last year.
So when you see a sell-off like this, I think now we're around 13–14% from the highs about, say, a month and a half ago. It's always difficult to be a market timer, but do you think that we've seen the bulk of it? Do you see now as a buying opportunity?
We felt that it is reasonable to expect a 10–20% correction at some point during the year of 2010, and that's still the range we would feel comfortable with. So is there a little more to go? Possibly, but we also would say that this is a correction. This is not the end of a rising market, and we would expect the markets to be higher year end.
Udo, was that correction accelerated by what's going on in the Eurozone?
I think that's a fair way to look at it. The Eurozone, or the developments there, whether it's Greece or now the Spanish banks, have been the catalyst or a big catalyst for this correction. But the correction would have come anyways. Expectations have moved too far ahead of the underlying fundamentals. And
why do you suppose that is?
Well, I think it's very much a behavioral development you see in markets happening very often. We had a phenomenal recovery from the lows in the marketplace. If you look at earnings estimates of, for example, U.S. companies, they have constantly been pushed higher as the recovery sort of was holding, was moving along, and at some point, typically expectations then move even beyond what fundamentals justify, and we got close to that point, or we are at that point, and so that has to correct.
Well, you're certainly not alone in thinking that stocks will be higher by the end of the year. Is the danger that expectations are still too lofty, not only for S&P targets, for example, but also earnings per share estimates, which in many cases are still pretty high?
Well, what we see and hear from companies would suggest otherwise. Companies give us a very solid, healthy feedback of how their underlying businesses are going, and so we are feeling very comfortable and confident in the underlying improvement of the business of many U.S. companies, European companies, and not to forget Asia in this context. So we really think this is a technical correction, and certainly we have issues to deal with, but not to derail, in our view, the overall market trend.
Udo, is this then a time where you see that emerging market economies may come out through the wilderness? Could they see this as an opportunity?
I think it is certainly from a shorter term perspective more of an opportunity, but I think again it is helpful you look at two aspects in combination. One is the long-term trend where emerging economies will see their market share growing in the global economy, and secondly, more of a tactical, more of a timing perspective when to capture the opportunities best for companies in the emerging markets or for investors that want to increase their exposure to emerging markets.
Udo, what about here in the U.S.? Are there particular sectors that you think are going to do better? I mean, everybody seems to love technology right now, but it's not a group that has necessarily outperformed for the year thus far.
In general terms, Julie, I think we would highlight that the focus should be on quality companies that you are comfortable that can grow in also more challenging market environments, that have healthy balance sheets, healthy cash flows, and to some degree to pay attention to dividend paying abilities also might be advisable. Now, having said that, as you mentioned, technology in particular, we believe that the underlying fundamentals of technology companies are fairly strong, and many of the quality criteria I mentioned before, certainly are met by many of the technology companies. So yes, the correction has hit NASDAQ-related stocks harder than many other areas, but then the recovery in those names, the performance of those names was much stronger in the first place. I see much of that correction really as just that, a correction in an upward trend.